you can own a stock in the best company in the world with the recurring revenues, with high returns on equity, huge margins, wonderful, wonderful business. But if you do this one thing wrong, it's not going to turn out very well for you. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated for microcap stocks which are ignored and underfollowed by the investment industry. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com, so make sure you get yourself a copy. When it comes to the universe of companies, you might have good companies, average companies, and below average companies or bad companies. And for any of those choices, you can overpay for it or you can underpay for it. So you can have the greatest business in the world. And we can use an example of PayPal. I love PayPal. I love PayPal's business. It's recurring revenue, brand name, right? It has a moat from a network effect. Network effect meaning the more people that have PayPal accounts, the more merchants want to accept PayPal. So it's a wonderful business model. When you look at the margins, gross margins are over 50%, 50. Net profit margins are about 14%. And you see, because gross profit margins are about 50%, then you can have wonderful net profit margin like 14%. Return on equity is about 10%, which is okay. It's not fantastic, but it's okay. It's stable. Return on assets is a little bit lower, about 5%. So it's a good business. It's not a fantastic business, but it's a good business. And I use PayPal. If you go to microcapexplosions.com and you click on the join button, you would find two options to pay. One is PayPal and one is Stripe. And I would happily accept any form of payment. And I've been using PayPal for a long time. It's a wonderful product for myself because I don't have to have credit card processing account with a bank. They usually charge like a monthly fee, whether you get paid or not. You have to pay the fee. What I like about PayPal or Stripe is that they only get paid their portion based on transactions. So if I don't get paid, they don't get paid. And I don't get charged a monthly fee. And they also have an option where when people sign up to Microcap Explosions, it's like an automatic renewal. So it creates a lot of efficiency for me. If somebody wants to stay, be a member for more than 1 year, it renews automatically. So the business model is fantastic. I love it. I love the company. And yet, if you look at the stock price, recently it was $300 per share. And today, it's approaching $100. It's down more than 60%. How could that be? The company is growing, the company is fantastic, the company has recurring revenues, loyal customer base. I mean, how could it be? And this is because just because you buy a good company doesn't mean it's a good investment. You see, if you have a great company and you overpay for it, it's probably not going to turn out for you that well. It's actually better for you to buy an average company or a bad company. If you pay very, very little for it, it might actually turn out much better for you in such a scenario than paying unlimited price for a wonderful company. Today, PayPal stock is about 125, and then the price to earnings ratio is about 36. So think about this. The stock is at 125 and the PE is 36. So when the stock was at over 300, the PE was about 90, okay? Now 90, so people thought it was a good idea to buy this stock and pay a PE of 90. In other words, if the revenues all of a sudden were to be stable, it would take about 90 years to get your money back through earnings. 90 years. And they thought it was a good idea. But you see, that's the thing, that growth investors forget that growth is a variable to value. The faster the company grows, the more valuable it is. I've showed you before in my videos on discounted cash flow analysis, the faster the growth rate, the more the company is worth. But unfortunately, growth investors only look at one variable. Is it growing? Yes. If it's growing, we pay any price for it. And the problem with this kind of thinking is that when a stock like PayPal is priced for perfection, any little hiccup, a tiny slowdown in the growth rate, which is exactly what happened. They just slowed down. They didn't stop. They didn't go backwards. They just slowed down. So it's like you're driving a Formula One car, 200 miles per hour, and all you need to go is go 190 and you're gonna crash. That's it. So when you overpay for these businesses and you pay these ridiculous valuations, just tiny disappointment can crush the stock. And that's exactly what happened with PayPal. We get the Fed raise interest rates, or the Fed scaring people into raising interest rates. It's not even the actual act of doing, it's just talking about raising interest rates. Then the company reports slower than expected growth. Boom. That's all that it takes for the stock to crash like this. And then people come out and then they're surprised. They're surprised. How could a company like PayPal go down? Well, if you overpay for it, then it's perfectly normal for it to come down to reality. And after it comes down from like 300 level to 100 level, then like, is it even reasonable? Well, think about this. Now the world knows that the growth slowed down, okay? And it's not like the company is new. The company has plenty of competition from Stripe. For example, 10 years ago when I was using PayPal, I didn't know about Stripe. Stripe wasn't around. Now Stripe is a very strong competitor. And actually, for microcap explosions, when I accept payments, I can see why. It's more user-friendly. You can actually call Stripe if you have a problem, and you will have a human answer the phone. You can't do it with PayPal. If something goes wrong, you're on your own. So I can see why Stripe is gaining market share over PayPal. And then you have, of course, Bitcoin, right? And all these cryptos that are competing. So going forward, because PayPal is a big, very well-known company, is nearing maturity. So of course, the growth rate will slow down. But even though the growth rate is slowing down, the company still has a PE ratio of almost 40. This doesn't scream cheap, right? So even at this level, I would say the stock is vulnerable to continuous sell-off because it's not cheap enough really to incentivize value investors to step in. And the growth investors, well, they're scared because their entire portfolio is in free fall. So they don't feel like they want to be adventurous and be buying it. But this is what happens. So as an investor, you have a choice. You can invest in good companies, average companies, and bad companies, and that's okay. You can choose any. Of course, the best case scenario that you have is to invest in excellent companies and to buy them cheaply. This is why I love microcap stocks, because this is probably the only area where I can buy fantastic business models. They might not be mature yet, but I can see that they are fantastic business models because I can understand what a fantastic business is. And I can buy those companies at very cheap valuations. You can't really do that on NASDAQ or New York Stock Exchange. Those super companies are always expensive. So I can't really ever buy them because of that fact. The only time when you can buy those super companies at a cheap price is when there's a crisis, like 2008 financial crisis, And even the COVID crisis in 2020, I wrote about a lot of those super businesses in my coronavirus book. They weren't cheap. They were reasonable, but they weren't cheap. It just shows you how you have to have a crisis or semi-crisis for these businesses to trade at reasonable levels. So if you are investing on the popular exchanges, NASDAQ and New York Stock Exchange, you most likely will never get good deals on those companies. As a result, most people are like, well, I can't ever buy them cheap, so I will pay ridiculous prices. And then when little hiccup happens, they get a haircut very fast. But you most likely going to get reasonable deals on average or below average companies. Yes, you can get good deals on them, especially when they have some problems. But then you are dealing with average companies. So I suggest when you're dealing with average or below average companies, you should have more margin of safety, meaning you should definitely never overpay for them. And what I see in the market now, especially among the growth investors, they don't differentiate between good, bad, and ugly. Like for them, as long as it's growing, ugly is fine. Very ugly is fine. Growing, it's wonderful. Return on equity, what is that? Margins, we'll make it up on volume. Like, it doesn't matter. They do not differentiate between good, bad, or ugly. Like, as long as it's growing, it's fantastic. And that's the worst combination, because you can get yourself in situations where you acquire horrible businesses and you overpay for them. That's definitely the worst scenario, because when they start crashing, time is not on your side, especially when they have debt and they're losing money. They can literally go to zero. With great businesses like PayPal, for example, even though you might get a 60% haircut, it's unlikely that those businesses will go out of business. You might have to wait years to recoup your capital, but at least the probability of them going to zero is low. In summary, you have choices. You can buy great businesses, average businesses, below average businesses. That's one side of the equation. Pay attention to what you're paying for them. Great businesses rarely will trade at cheap valuations. They might trade at reasonable valuations. Most of the time they trade at ridiculous valuations, and you can only get them at reasonable or cheap valuations during crisis. Average businesses, yes, they can be cheap, but they might be cheap for a reason. For me, that's why I love microcap stocks, because I love buying great businesses that are becoming greater and greater with each day, and I get to buy them at cheap prices. Thank you for watching. I hope you enjoyed this. I would greatly appreciate if you subscribed, if you click the notification button, if you comment on this video. I will try to respond to every comment, and if you shared the video, I wouldn't mind. Thanks for watching.